Hello friends, hope you're doing well. Chris Lee, CPA, back here with another video for you. So today we're going to talk about tax consequences related to life insurance policies, primarily those tax consequences that occur when you have transactions with life insurance policies while you're still alive. When it comes to death benefits, it's generally pretty straightforward. If you have life insurance that's self-funded, the proceeds upon death, the death benefit is generally tax-free. And if you have life insurance policies that are funded by an employer or such, that the death benefits are, taxable. But when it comes to life insurance and, transactions that occur while you're still alive, there are more than people generally recognize. The first thing to know is that these transactions occur when you have permanent life insurance policies or whole life insurance policies. So when it comes to life insurance, you have two basic types. You have term life insurance and whole life insurance. So term life insurance lasts for a set number of years, typically somewhere between 10 and 30 years. If you die during that term of the policy, your beneficiaries will receive the death benefit of that policy. If you die after the term, your beneficiaries receive no death benefit. So the money from your term policy, kind of goes nowhere if the policy lapses and such. Now, when it comes to permanent life insurance policy or whole life insurance, I'll probably refer to it as whole life insurance during this video, but so when it comes to whole life policy, these policies last your whole life as long as you pay the premium. And when you die, the death benefit accrues and is paid out to your beneficiaries. So permanent whole life insurance, permanent policies include savings accounts components. Okay, you'll see there are financial commentators out there that will say never have a whole life insurance policy. Some people are big fans of them. There are lots of consequences and things to think about of when it's the right product for you. We always, whenever we're thinking about these sorts of financial decisions, we want to lead with our goal or the problem we're trying to solve, and then look to the products that help fill that gap. We don't want to think just solely on buying products that sound sexy or something that social media is encouraging or that sort of thing. So, but the permanent policies, like I was saying, have kind of a savings component. A portion of the premiums paid are placed into, go into paying up the policy, right? That the insurer can, keep the policy intact. And another component goes to a cash value account, kind of like a savings account. And the sum of this account grows on a tax deferred basis. So you put money in over time. The value in that kind of cash value, little savings account component of that insurance policy, earns interest and dividends. And so the value of that account grows. So you continue making deposits into the account as you pay into the policy. The policy has two pieces. It's funding the death benefit and the cash value. The portion that funds the cash value goes into the account, and then you get that compounding. You get that interest, and there could be an investment component where you're getting dividends, and so the value grows. So over time, the policy's cash value can be accessed while you're alive. So with that said, whole life policies come at a much higher cost. So they're usually 10 times as much or even more of their term policy equivalents. But they still have, legitimate reasons to be in place. So the several types of permanent life insurance policies, I also call them just whole life in general, but that's also kind of a specific category, but that's kind of a generic term I use for them. But with these you can have a category that's called whole life. With these policies, you pay the same premium for life, and the cash value grows at a guaranteed fixed interest rate set by the insurer. Then you have universal life policies, where your premiums are flexible and you can accept less coverage for lower premiums. So it's variable. It has a component where the premiums can shift through life. You have variable life insurance, which is a permanent life insurance policy where you invest your cash value, usually into mutual funds. And so that's where you can even get greater capital appreciation within the account. But the premiums, they lack that flexibility that you see in like a universal life policy. So the premiums stay very fixed, but you get more investment options within the account. So then you've got, so you've talked about whole life, fixed premiums, cash value grows at a guaranteed fixed interest rate. Then you've got universal life. You can have premium flexibility, but you also accept lower death benefits. You've got variable life where you can invest in mutual funds, but the premium stays very fixed. Then you've got variable universal life. This combines the benefits of universal life and variable life components. Your premiums are flexible, and you can invest the dollars into, more traditional investment avenues such as stock, bonds, mutual funds, sometimes even more flexible assets. So your premiums can increase or decrease depending on the investment returns. And then you have index universal life. So these policies, they grow the cash value based on the stock market index. So you might be indexing like the total stock market index, or you might be indexing the S&P 500. So the account grows, and commensurate with the underlying economics of that, market index. Now, moving beyond kind of the package, now we're going to talk, what kind of flavors these permanent life insurance policies can come in. We'll talk a little bit about the different types of transactions that occur. So for one, you can have a partial cash withdrawal from the policy. So when this occurs, you can withdraw cash and you're not canceling your policy. So when you do this, you've probably been building up a cash value, growing in that, cash value account through small deposits over time. It's going to take several years, sometimes, 10 to 15 years for the cash value to grow enough to make it tapping into it worthwhile. And so when you tap into this, you don't have to pay the amount back, pay back the amount you withdraw. But the whole policy and the cash value policies, your withdrawal will reduce the cash value of your policy and reduce the death benefits your beneficiaries would receive when you die. The important benefit, your withdrawals are tax-free up to the value of the total premiums you paid. So the premiums you paid create your basis in the account, so like what you paid in, and you pay tax on ordinary income rates at ordinary income rates on the withdrawals you take in excess of your basis. So say you paid $100,000 in premiums for your whole life policy, and the policy now has a cash value of $300,000. Okay, so you've paid in 100, you've got a value of 300. You withdraw $250,000 out. The first $100,000 that comes out is tax-free. The next $150,000 is taxable as ordinary taxable income, which, depending on all your financial factors, that might be a tax rate that could be regrettable, right? Because we can go up to 30 to 37% and such. When this sort of transaction occurs, right? Like, so it's a as long as you're not taking in excess of your basis in the account, it's not taxable, but anything in excess will be. When these transactions occur, you'll receive a Form 1099-R showing the total proceeds you received and the taxable amount. Your insurer should be, tracking this for you. So the second way you can kind of access your policy is to surrender your policy. So this is, you can surrender your permanent policy, and this means you're just terminating it, and you're paid the policy's cash value less the surrender fees. So the fees can be pretty high, sometimes 10% or 35% of the policy's cash value during the first several years of your policy. So if you surrender it early after the, signing the documents and effectuating the policy, you can pay pretty high fees, but those fees go down over time. Usually, somewhere like 1%, usually go to 1% after 10 or 15 years. So once the policy's in effect long enough, the penalty goes down substantially. As with partial cash withdrawal, you'll owe no tax on the portion you surrender that represents the return of the premiums you paid in, that returns the basis, so your cost basis and your cash value account. So anything you receive in excess of that is going to be treated as ordinary taxable income and paid at and subject to tax at ordinary income tax rates. So assume you paid $10,000 in premiums over time, you held the policy, and you receive a $15,000 payout. The first $10,000 you receive from the surrender will be tax-free. The remaining $5,000 will be taxed as ordinary income at ordinary income tax rates. So the third option, and this is where social media loves to talk about these items, is you can take a loan from your life insurance policy. People love to talk about how loans aren't taxable income, which is very true. But loans also carry their own inherent risk profile. So when you have a permanent policy with a cash value, you can usually you can often use the collateral of that policy, the cash value, as a collateral for a loan from your insurer. So the loans are easy to get; they don't affect your credit. You don't have to go through a credit check. And the loan is typically capped at 90 to 95% of the policy's cash value. If you've got one of those policies, the variable policies that have more investment options, because that policy has much more market fluctuations, they may have a different cap on it. But regardless, the loan amount will have some sort of cap based on the policy's cash value. This is essentially a personal loan from your life insurance company. You would generally, you must pay interest, but if it can be lower than the interest you'd be charged by banks for personal loans. Unlike traditional banks, these loans also have no payback schedule or repayment schedule. You decide when and how to pay the money back. You don't have to make any payments of the principal or interest while you're alive. The interest you owe will be added to the loan amount, which can basically create what we call negative amortization. So when you die, the unpaid amount you've borrowed plus interest is subtracted from the death benefit that would be paid to your beneficiaries. And so if you don't make any payments, because of that negative amortization where the loan value goes up because of the unpaid interest, you've got more outstanding loan. The consequences is that you could eventually exceed your policy's cash value. So you borrowed more money than the cash value is there. If this occurs, your policy could terminate, and the insurer will use the cash value to pay off the loan. You'll also owe income tax on the amount of the cash value proceeds that exceed your total payments into the policy, right? So that cash value builds, you've got that policy. So you've got that amount you've paid in, the cash value builds, you take a loan on this increased amount. If that policy, if you overdo it on the loans, all of a sudden that cash value gets used to pay off the loan. And so that gap of what you paid in versus the value of it becomes that similar consequence of ordinary income tax that we've seen in those previous transactions, right? So you get a tax consequence even though the value of the cash paid off the loan. So usually we don't see cancellation of debt or something else paying off a loan. Usually we don't see that sort of consequence of paying off a loan creates taxable income. But this is a scenario is because you've got some built-in gains into that account that is being used to pay off the loan, and now that it's used to satisfy a personal obligation, you've had an accretion of wealth with that is no longer tax deferred. It becomes taxable. Now, talking about how there didn't need to be payments made, you can choose to make payments while you're alive to preserve the death benefit that your heirs would receive and avoid having your policy lapse. So your payment options could be periodic payments of principal with annual payments of interest, paying interest only, or deducting the interest payments from your policy's cash value. So the good thing, any amounts of payments you make on the value of the policy's cash value, if you make payments from your policy's cash value, that is, any amounts taken from your policy's earnings are taxable. So one feature of borrowing from your policy is that it does not affect your policy's cash value in general, unless you're making some sort of choice that the cash value is going to pay off the loan. The cash value will continue to earn interest and grow tax-free. If you have a life insurance policy that pays dividends, the interest you earn on your cash value plus the dividends you should receive may equal or even exceed the interest charged on your cash value of the loan. So like I said, the insurer is giving you a loan using the cash value of your life insurance policy as collateral. And so they oftentimes will charge a lower interest rate than a bank. Within your cash value account, though, that principal, that what you've paid in stays intact and it keeps accruing interest and dividends. The interest and dividends could be at a greater rate than you're being charged on the interest of the loan. So you get some arbitrage in there. And so that can be a benefit. Like all loans, the cash value policy loans are also tax-free. Some people like the idea of borrowing from their policy so much that they will try to like super fund their account like in the first few years, like really throw a bunch of money into it and contribute more to the policy's cash value so they can borrow more. In later years, what can happen is you can have what's called overfunding, and this can occur if it becomes, according to IRS standards, what's called a modified endowment contract. So when your policy becomes a modified endowment contract, it's really unfavorable tax consequences. The consequence there is withdrawals and loans from these modified endowment contracts, or MECs, are treated as coming first from your policy's cash value earnings, right? Like, so it's not tax deferred. It's, it's in a last in, first out order. So payments, withdrawals, and loans are first treated as coming from the policy's cash value and earnings and are taxable to the extent that it exceeds your basis of what you've paid in there. So the withdrawals before 59.5 also incur a 10% penalty, unless there are certain exceptions. But your policy being classified as a modified endowment contract, if you overfund it, can be, not ideal. So we just need to think of, usually the policy will indicate, if you're getting close to the funding limits, right? Like your policy holder will know what the IRS standards are for the policy limits are for the year, and they should be letting you know if you're getting close. But your policy can be classified as a modified endowment contract if you overfund it to the extent that it would be fully funded using 7 equal annual payments during the first 7 years that policy is in effect. That is that's kind of the math of how the MEC limit works, the modified endowment contract works. Like I said, these should be in your contract, your life insurance contract. So, and your insurance company should be warning you if you're about to reach the limit. The next thing you could do is you could actually sell your life insurance policy. So there are some banks and hedge funds that will buy life insurance contracts. This is called a life settlement. So the buyer will pay the premiums and collect the death benefit when you die. You give both your policy's cash value and the death benefit to this bank or hedge fund in exchange for cash. Your beneficiaries will receive nothing when you die. The life settlement concept might seem like odd, but you may actually receive more this way than if you were to surrender it. Typically 10 to 25% of your policy's death benefits. The shorter your probable lifespan, the less time the buyer of your policy will have to wait to collect, and the more it will be willing to pay you for your policy. So they're doing a time value of money calculation to say, okay, if I give you this much now, what's my rate of return when, given your life expectancy when you die in the future, and can I earn a spread on that? So specialized brokers often handle these transactions, and so you can deal directly with you can also deal directly with third-party purchasers and avoid broker commissions, which can be substantial because these are unique contracts, unique transactions, and when this occurs, you'll get, you'll pay a premium for that. So the tax consequences here, life settlement proceeds are, tax-free up to your basis, which are the total premiums you paid. And proceeds above that are taxable in 2 tiers. The proceeds over the cost basis and up to the cash surrender value, that cash value in the account, are taxed as ordinary income. Proceeds over the policy's cash value are taxed as long-term capital gains. So let's assume someone has a $100,000 life settlement contract. So they sell their life insurance contract as a life settlement transaction for $100,000, and it has $50,000 of cash surrender value in the policy. In that policy, the seller had paid in $40,000 of premiums. So you've got a $100,000 sale price, $50,000 cash surrender value, $40,000 of premiums paid. So his taxable gain in total is $60,000. The $100,000 received minus the total premiums paid of $40,000. So 100 minus 40 gives us a total gain of $60,000. The gain that is taxed at ordinary income rates is the gain, the total gain minus the cash surrender value. So our $60,000 total gain, which is the 100 minus the 40, less the cash surrender value of 50, gives us the 10. So then of the total gain, right? So we have 2 tiers. We've already considered the first tier, which was the $10,000. It's the total gain less the surrender value. All right. So how much of the gain is attributed to not returns in the market, essentially, or related to the contract itself, essentially. That's $10,000. The second piece, that's taxed at ordinary income rates. The remaining piece is going to be taxed at long-term capital gain rates, which is $50,000. The total gain minus the $10,000 at ordinary gives us the $50,000 capital gain. So that could be, that 20% tax bracket that we sometimes see. So those transactions can get complicated. So I really recommend you have a professional that can kind of understand the economics and how these calculations work. And kind of like the last way that you'll see some people receive receive cash out of their policies during their life are if your life insurance contracts can pay out a viatical settlement to policyholders. And so this is when you are terminally ill as certified by a doctor, to have less than 2 years left to live, or chronically ill, or, disabled. And those proceeds are going to be used to fund long-term care that's not covered by insurance. So you're basically getting the death benefit before you die to cover long-term care. What you get is that the entire proceeds are tax-free, similar to if someone had already died and those benefits were going to get paid out and be tax-free, only they're being paid out during someone's life. So viatical settlements are typically much larger than life settlements. So, how we were talking about sale to a third party is considered a life settlement contract. So viatical settlements can occur, by, transferring the policy elsewhere, or if you get paid out from your policy in a viatical settlement. They're usually higher, paying 50% to 85% of the death benefit amount, depending on the policy's life expectancy. So this is a way for terminally ill or disabled policyholders to get a substantial sum of money, tax-free. So key takeaways for this video. Permanent life insurance, has a cash value account that grows over time. It's kind of like a savings account, may have some investment options. So policyholders can access these cash values while you're still alive in a variety of ways. You can take a partial withdrawal from the account, tax-free to the extent of what you've paid into that cash value. Withdrawals over that cost basis of what you've paid in, right? That value grows with interest and dividends generally. If you receive payouts that exceed what you've paid into that cash value account, you have ordinary income tax consequences. Withdrawals generally don't have to be repaid, but they will reduce the policy's death benefit. A permanent life insurance policy can also be surrendered to the insurer. So you basically cancel the policy, terminate the policy. And so at that point, the insurer will pay out the total cash value less any fees. The payment also, if you receive proceeds in excess of what you've paid in to the cash value, is taxed as ordinary income. Policyholders can take out loans with their insurer using their cash value as collateral, generally tax-free, but if unpaid when you die, the outstanding loan balance will reduce the death benefit to your beneficiaries. And older or terminally ill policy holders have the option of selling their policy to third parties, or not older and terminally ill. You can sell your policy to third parties, to receive, access to the benefit now without having to die. The sale proceeds are taxable to the extent they exceed the cost basis. But biatical settlements are generally tax-free. So that's just a consequence. So if you're doing it just to offload the policy, you'll have tax consequences. You can have a two-tier approach where you can have two separate tax consequences, where you've got an ordinary tax consequence and a capital gain tax consequence. Under biatical settlements, you generally are going to be tax-free. So, so anyway, that's all I've got for you today. Back soon with another video for you. In the meantime, feel free to connect via the link in the description. You can book a call on the website if you have any questions you want to talk about as you grow your wealth. But regardless, stay happy and healthy. Wishing you the best in your year. Take care. Bye.